So good afternoon and thank you for joining us. We're here from Malta's Financial Intelligence Analysis Unit, which is for the benefit of our non-Malta based listeners, is Malta's Financial Intelligence Unit on the one hand, but also Malta's Anti-Money Laundering Supervisor. My name is Clara Borg-Bonacci. I'm here from the FIAU's Guidance and Outreach team. So our team is the section that's responsible for drafting guidance on implementing anti-money laundering obligations and providing training and outreach initiatives in general. Today, we're going to be joined by my colleagues Carmen Umbro and Roxanne Borch, who are with me in this room, and we're going to be delivering this webinar as an introduction on trade-based money laundering. So the session, please bear in mind that the session is being recorded. However, videos will not be shown, but I do encourage you to keep your videos turned off even for the sake of your internet connections. And the recording will then be uploaded on our website once the session is over. I also kindly ask you to keep your microphones turned off. And should you have any questions, you can post these in the chat, and then we'll have some time for questions at the end of the webinar. So in a nutshell, trade-based money laundering is the misuse of trade and trade finance instruments to launder money that has been generated from criminal activity. So it involves those entities that provide services that facilitate trade. So this could be banks, financial institutions, company service providers, but also it inevitably ropes in those entities that provide business support in general, such as accountants, auditors, and lawyers. We're looking at subject persons from an AML point of view. Now, Malta is considered an international financial center with a big export, strong reliance on importation, and those number of locally registered companies. So all these factors increase our inherent exposure to this type of. So it's worth of this typology, and that's introducing trade-based money laundering today. Now, Carmen is going to be explaining the different schemes or typologies through which trade transactions are misused or abused to launder funds. And then in the second half of the session, Roxanne will break down a case of trade-based money laundering that was analyzed by the FIAU, so by our intelligence analysts. And then I'll close up the session with some more red flags on trade-based money laundering. So I'll just pass the video over to my colleague Carmen.
Thank you, Clara, and good afternoon, everyone. I would like to start off this presentation providing you with some practical information on how often and how strongly trade-based money laundering is used by criminals to launder dirty money. As we can see from the first slide, every year, roughly $1 trillion in illicit capital flows out of the developing economy, and the significant majority of this capital involves trade misinvoicing related to quantity, quality, and price. In fact, in the world, hundreds of billions of US dollars are every year laundered by trade-based money laundering. As a consequence, trade-based money laundering represents one of the largest money laundering methods in use. In 2006, the FATF published a landmark study on trade-based money laundering, and it concluded that trade-based money laundering represents an important channel of criminal activity, and given the growth of the world trade, it is an increasingly important money laundering and terrorist financing vulnerability. More precisely, one of the three major money laundering methods. Moreover, the report concluded that as anti-money laundering techniques applied by subject persons become increasingly effective, the use of trade-based money laundering is expected to become increasingly more attractive and, unfortunately, more sophisticated and difficult to be detected. So, what is trade-based money laundering? Let's see together the definition. Trade-based money laundering is the process of disguising the proceeds of crime of moving value through the use of trade transactions in an attempt to legitimize their illegal origins. From this definition, we can already extrapolate the three underlying common factors of trade-based money laundering, which are, as we can see, the disguising of proceeds of crime, the movement of value of goods and services, and the use of a trade-related financial transaction. Let's examine them one by one. The first one The first one is the disguising of proceeds of crime. So whenever there is trade-based money laundering, there is some dirty money to be laundered. So the question is, where such dirty money comes from? From studies carried out from many trade-based money laundering cases in the world, a number of predicated offenses were identified as trade-based money laundering predicated offenses. They include illicit trafficking in narcotic drugs, which represents one of the main concerns. Then illicit trafficking in stolen or other goods, corruption and bribery, tax evasion, which it represents around 15% of the total of the predicated offenses. Then there is fraud, piracy of product and smuggling, human trafficking, and organized crime, in primis racketing. The second common underlying factor of trade-based money laundering is the movement of value of goods and services for illegal purposes. This concept is very important. Trade-based money laundering is, in fact, about value, not only about money. The key word of this definition is value. We often think about money, but, for example, you all can see this biro in the picture. So how much does it cost? If the seller, you can say that if the seller and the buyer are in agreement, it can cost whatever they want to be. From this basic statement, we can already understand how important is the element of collusion in a trade-based money laundering scheme. We can say that without collusion, trade-based money laundering would not even make sense. However, we will speak about the element of collusion even at a further stage, especially when we will be presenting you the local case. Now we can come back to the third factor that characterizes trade-based money laundering, which is the use of a trade-related financial transaction. Trade-based money laundering is always related to trade transactions, and very often these transactions involve trade finance services. What is trade finance services? Trade finance, we can say that literally it means financing for trade. This is an umbrella term used to group together services provided by credit institutions to facilitate the trading of goods, the provision of services. By and large, trade finance services can be divided into two subcategories. Service related to documentary transactions such as letters of credit or bills for collection services, referred as documentary credits, and service related to open account transactions. This category is very important because about 80% of international trade is conducted on open account. And this is where the biggest trade-based money laundering risk exists, especially through misinvoicing. We will see these schemes soon. So, coming back to the trade finance, it is from the abuse of the trade finance services that trade-based money laundering offenses take place. This concept is very important because it highlights the importance of for banks and in general credit institutions to have strong anti-money laundering procedures in place in order to mitigate in an effective manner the money laundering risks associated with trade finance. Moreover, it is important to add that also other subject persons are involved in this challenge to combat trade-based money laundering. Whenever there is trade, there are companies involved. It comes by itself the importance of company service providers to have a strong ongoing monitoring procedure in place to understand which transactions are taking place and to be able to understand if something wrong is going on. Now, before moving to the second part of the webinar, a very practical part where we are going to explain the different trade-based money laundering schemes, I would like to make a small note. We often speak about trade-based money laundering, but it is a mistake to think that trade-based offenses are just linked to money laundering, because terrorist financing is something very important to be mentioned. In fact, in the past, many terrorist attacks took place have been financed by been funded by trade-based terrorist financing. So in this webinar, obviously for timing reason, we are going just to speak about trade-based money laundering, but it's important to bear in mind that terrorist financing is something that trade-based abuse also concern trade-based schemes. Now we are going to move to the second part of the webinar, just explaining the different trade-based money laundering schemes. So, how does trade-based money laundering takes place? The most basic schemes involving trade-based money laundering are over and under invoicing, multiple invoicing, over and under shipments, falsely describing goods and services. Let's go through them one by one. Let's start with the first one, over invoicing. And just before starting, I want to add this concept. Over and under invoicing are both related to a common factor. They entail a misrepresentation of the price of the good. So whatever there is over or under invoice, there is a misrepresentation in the invoice of the price. So let's start with the over invoicing of goods and services. Trade-based money laundering through over invoicing entails the inflation of the price of the goods stated in the invoice. By invoicing the goods or services at a price above the fair market price, the exporter is able to receive value from the importer. As the payment for the goods or services is higher than the value that the importer will receive when it is sold to the open market. Let's see an example to clarify this definition. In this picture, we can say that we can see already company A, which is in this case Maltese exporter, that ships 1,000 byros worth €2 each, but invoices company B, which is a colluding Italian importer, for 1,000 byros at a price of €3 each. So the price have been clearly inflated. The total price invoiced is €300 instead of 3,000 euro instead of 2,000. So company B pays company A for the goods by sending a wire transfer. Let's say sending a wire transfer for 3,000 euro, although it received 2,000 euro value. Company A then pays 2,000 euro back to its suppliers and deposit the remaining 1,000 euro, so which is basically the difference between the invoiced price and the fair market price, into a bank account to be disbursed according to company B instructions. This is just an example. So we can also say that this 1,000 euro, the difference between the invoiced price and the fair market value, were money coming from drug trafficking, let's say, and such methods that money have been laundered. Something very important element. First of all, such situation would not make sense unless the exporter and the importer were colluding in a fraudulent transaction. As we said before, as we are going to see later on, collusion is this particular Then the second element is that
the full presentation. Shorter to done in network one.
So they gave you, for example, parent companies. And then the third conclusion is that over and under invoicing of exports and imports can have significant also tax implications. An exporter who over invoices the value of goods and he ships the goods that he ships is able to significantly increase the value of the export tax credit, the called VAT rebate, that he receives. On the other side, an importer who is under invoiced for the value of the goods that he receives may be able to significantly reduce the value of the import duties or custom taxes that he pays. So both these cases illustrated the link between trade-based money laundering and abuse of the tax system. Under invoicing, under invoicing on the other side entails the invoicing of goods and the services at a price that is inferior to their fair market price. In this way, the importer is able to transfer value to the importer and as the payment of the good or the services will be lower than the value that the importer receives when it is sold to the open market. Let's see another example. In this second picture, we have a company, this time an Italian exporter, which ships 1,000 biros worth to euro each, as we said before. But this time, this company invoices company B, which is a colluding Maltese importer, for 1,000 biro at a price of €1 each. Company B, the Maltese company, pays Company A, the Italian company, for the goods by sending, in this case, a wire transfer for €1,000. Company B then sells the biros on the open market for €2,000 and deposits the extra €1,000, so the difference between the invoiced price again and the fair market value, into a bank account that will be disbursed according to Company A's instructions. Research suggests that under-invoiced exports is one of the most common trade-based money laundering techniques used to move money. This reflects the fact that primary focus of most custom agencies is to stop the importation of contraband and ensure then appropriate import duties are collected. The conclusion is that custom agencies generally focus more on the monitoring of export than imports. It is also worth noticing that the more complex the good being traded it is, the greater the difficulty the customer agency will have to identify cases of under and over invoicing. This happens because when they are in front of particular complex or rare goods, it is very difficult to quantify, to give them a price. So to detect cases of under or over invoice becomes even more difficult. Now we are going to see over and under invoice from a different perspective, let's say from a criminal perspective. So the question is, what would criminals do to move dirty money out of the country? We can say that a criminal might over-invoice imports. So let's say value of imported goods and services is 100, but they pay 200, allowing them to transfer 100 in illicit funds. Similarly, they can decide to under-invoice exports. So in this case, value of exported goods and services is 200, but they sell or invoice for 100, so that 100 in value is sent out. On the other side, if criminals want to move dirty money into the country, they will either under-invoice imports or else over-invoice exports. Here you can see some other examples. We can now move on to the next scheme, which is multiple invoicing of goods and services. This trade-based money laundering method entails invoicing multiple times for the same international trade transactions. So by invoicing the same good or services more than once, a money laundering is able to justify the multiple payments for the same shipments of good or delivery of service. Even if a case of multiple invoicing is somehow detected, there are a number of legitimate explanations for such situations, including, for example, the amendment of the payment terms or the corrections to previous payment instruction or the payments or of late fees. Moreover, unlike over and under invoice, it should be noted that there is no need for the exporter or the importer to misrepresent the price of the goods or services in the commercial invoice. If the prices are correctly reported to custom agencies, the detection of the criminal activity becomes even more difficult. So they try to stick to the real price. Let's see now another scheme, which is the over and under shipment of goods and services. In addition to manipulating export and import prices, a money laundering can overstate or understate the quantity of goods being shipped or service being provided. This technique is called over and under shipments. This is similar to over and under invoicing, since value is transferred to either the buyer or the seller, but in this case, the parties misrepresent not the price, but just the quantity of the goods. For example, a company A sells, let's say, 100 of those famous virus to company B for 100 euro, which reflects the value of the goods on paper. But in reality, company A ships 200 euro, which are worth 200 euro. In practice, company B receives illegitimately an additional 100 euro worth of goods. This is clearly overshipment examples, and it is worth noticing that overshipment can also be used to avoid import duties, since obviously the quantity of goods declared in the invoice and in the other documents is inferior to the real shipment. If we want to see an extreme case of in this time under invoicing, we can mention the ghost shipping. Ghost shipping is in such a scenario, an exporter may not ship any goods at all, but simply collude with the importer to ensure that all shipping and custom documents associated with this ghost shipment are processed. Banks and other financial institutions may not be involved in the provision of trade. Maybe not even, maybe they can provide some trade finance service linked to this ghost shipping without even realizing that they are part of this particular scheme. So it is a quite worrying category of trade-based money laundering. Now we can move on to the last basic scheme of trade-based money laundering, which is falsely describing goods and services. This scheme entails the misrepresentation of the quality or type of goods and services. Exporters can falsely describe the goods or services being transferred, either inflating or deflating their value in order to pay off or get paid off. It is interesting to note that this particular trade-based money laundering typology works best with so-called invisible services, such as legal advice, management consultancy, and marketing research. In fact, it is easy to understand that the fair market value of this service can present more difficult to be evaluated. Now, going back to the introduction, you maybe remember that we said every year roughly $1 trillion US dollars in illicit capital flows out of the developing economy, and the significant majority of this capital involves trade misinvoicing related to quantity, to quality, and to price. At this point, we should be able to make this conclusion that whenever there is a misrepresentation of a price, it means basically that there is an over and under invoice scheme. If we notice a misrepresentation of quantity, means over and under shipment. And finally, this is the last scheme we saw, misrepresentation of quantity entails falsely describing goods and services schemes. Similar concepts applicable to trade-based money laundering schemes are applicable also at a digital level, with online merchants benefiting from false sales transaction known as transaction laundering. I just quoted it, however, it can be a subject of maybe another webinar. Now, by way of conclusion, I would like to clarify that we went through the very basic schemes through which trade-based money laundering takes place. However, trade-based money laundering techniques vary in complexity and are frequently used in combination with other money laundering techniques to further obscure the money trail. So, subject person should not forget that there are many other trade-based money laundering methods that every day takes place around us. Now I would like to pass the microphone to my colleague Roxanne, who will be presenting you a local trade-based money laundering case. Thank you, and thank you for your time.
Thank you, Carmen. And now we're going to tackle a case study which is based on a local case analyzed by the analysis section of the FIAU. Now, the subject person that is involved in this case study is a bank. The client is a company registered in Malta, which we'll refer to as Company A, and the suspicion was raised during analysis of transactions. Now, let's take a closer look at Company A. So as we said before, this Company A was registered in Malta. Its principal activity is the importation of electronic goods, and it also holds a bank account with a local bank. And the CBO is the Italian Mr. T. Now, this Company A transacts with Companies C and D, and also with Spanish construction company, Company B. Now, it's important to keep these two companies in mind because we're going to learn more information about them in the slides to follow. Now, let's delve into the facts of the case. So the bank required Company A to justify a number of high-value transactions that the bank considered to be inconsistent with the profile of the electronics importer. It also asked Company A to substantiate these high-value transactions with invoices and other documents. Company A complied and supplied these invoices and receipts as requested. Now, the bank assessed the invoice and receipts that it received from Company A, and it concluded that it had strong suspicion that the invoices were forged. It has also strong suspicions that the transactions were fictitious, and also there were indications that the price of the good as indicated was overinflated. What it also found out as well was that there were transactions with the Spanish construction company, Company B. However, there may be justifiable reasons for this, and that is why the bank wanted to delve deeper into the issue, and hence it assessed further the transactions of Company A. And what it found out was that most of the transactions of Company A were with the Maltese incorporated companies C and D. These companies, A, C, and D, were all owned by the same UBO, that is Mr. T, and also that there were multiple intercompany loans between the three main companies. As a result, based on the information that's at hand, the bank had strong suspicion that trade-based money laundering was taking place, and as a result, it filed an STR with the FIAU. Upon receipt of the STR, the FIAU made inquiries with its overseas counterparts, which revealed that a number of companies that received or remitted funds to Company A and Company C were also the subject of suspicious transaction reports in those countries, and also some of them were referred for investigation by the competent authorities of these countries concerned due to suspected VAT carousel fraud, false invoicing, and crimes of financial nature. Now, based on the analysis of information that the FIAU had, it reached determination that there were sufficient elements to reach the conclusion that there was reasonable suspicion that Company A, Company C, and their UBO may possibly be involved in VAT carousel fraud and in trade-based money laundering. Now, let's move into red flags that were present in this case study. Now, as you know, red flags are those behaviors, activities, transactions, or patterns of transactions that indicate that something isn't quite right. However, a red flag isn't an automatic indicator that money laundering or funding of terrorism is taking place, but it should attract your attention, as that if you spot a red flag or two, you assess the situation, gather more information to either justify this unusual behavior or else might determine that there is suspicion of money laundering or funding of terrorism. Now, the first red flag that is present in the case study was the fact that the Spanish company, Company B, whose principal activity was construction, is inconsistent with the business carried out by Company A, whose principal activity was the importation of electronic goods. Now, the fact that a business does business with another company whose business is inconsistent doesn't necessarily mean that something is wrong. However, it means that a red flag cropped up, which needs to be assessed further in order to justify where it took place, or else you determine that there is suspicion of money laundering or funding of terrorism, especially if maybe there are other red flags which crop up, as was the case in this case that we have just seen. Now, the second red flag was that the other two Maltese companies that Company A transacted with, that is Company C and Company D, all had the same UBO as Company A, this Italian UBO. This red flag reveals links between the companies because they had the same UBO. And as you know, trade-based money laundering requires collusion between traders at both ends of the import and export chain. And when there are related party transactions, that is transactions between entities that are part of the same corporate or business group, it makes trade-based money laundering easier for the parties involved. However, it makes it more difficult to detect, both for the subject person and for the authorities concerned. The third red flag was that there were intercompany loans between these two companies. Now, the presence of these intercompany loans, together with the fact that they share the same UBO, it could mean that intercompany loans are just a front, and that in reality, these intercompany loans are just a way to transfer and layer funds in what might seem as a legitimate way. And finally, the fourth red flag present in this case study was the fact that a number of invoices issued in relation to transactions carried out between Company A and C were suspected to have been forged or show inflated prices in order to justify the substantial transfer of funds. Now, here you can see there were significant discrepancies between the value of the commodity as reported in the invoice and the commodity's fair market value. And this is usually done either in conjunction with the misdeclaration of the description or quality of goods, or even without it. And as mentioned earlier by Carmen, forged and overinflated invoices are traits of trade-based money laundering. So, as highlighted throughout this case study, the signs that subject person have to look out for to determine whether trade-based money laundering is taking place is connection between companies, same or related UBOs, transactions between companies which is outside of the business activity, who don't have any logical or economic justification, and also intercompany loans. And finally, I would like to conclude with this last line that I would like you all to keep in mind, is that there is no trade-based money laundering without collusion.
Thank you, Roxanne, for this interesting case study. Thanks for going through the case study. I find case studies to be a really effective way to put red flags into context and bring typologies to life. In this case study, we saw the evidence of collusion between companies. Well, actually, in this case, it was the same person. So I suppose it's the best form of collusion you can have, but that's something that you need to look out for. And we also saw how important it is to act on unusual or atypical elements, such as trading connections that don't immediately make sense, as you mentioned. So you will have an electronics importer trading with a construction company in another country. Of course, it could be that there is a plausible justification for this trade, but in this case, it piqued the bank's interest, or it alerted the bank, and the bank investigated further, and delving deeper into the documentation, it discovered a whole host of other red flags. So that's something that you would need to assess. Now, in this last part of the presentation, we're going to look at some other red flags that indicate that trade services and trade transactions could be misused to launder criminal money. One of the more prominent red flags that often leads to suspicion and submitting of an STR is the unusually large purchases on the invoice. So what is unusually large? Naturally, one would ask you. That is obviously relative to the type of operation that you are dealing with, that your customer operates in, and your customer's business. So it's different if your customer is a corner store or a large franchise. And something is also unusual if it's not in line with your customer's usual activity. So the patterns that you've come to know and expect of your particular customer. Once again, a red flag is just a trigger for further assessment. There could very well be a legitimate reason for this significant diversification, perhaps in activity. And you should also be wary if the business has just been established and there are huge transactions or multiple volumes of transactions going through. I mean, is this instant success, or is it perhaps a new branch of a well-established enterprise? Or is the business just a front for moving funds and all they've been waiting for is to establish the business and start layering funds? Similarly, if the goods being purchased don't make sense in comparison to what you know about your customers, this would need to be looked into. At worst, it could lead to the submission of submission of an SDR on the basis of suspicion. At best, it could lead you to determining that your customer has changed or has diversified their business activities, and you would perhaps need to revise your customer risk assessment to cater for any new risks that this might expose you to. So a proper assessment of the documents that you receive to justify transactions, if these are needed, can also reveal some important smoking guns. So for instance, if the price on the invoice is different to the usual value of the good, and other similar but important discrepancies between all the documents that you have in front of you to assess or to justify the transactions. Another set of red flags is if the transaction involves higher than usual, then caution should be exercised. Firstly, to understand why your customer is dealing in such a risky situation, but also for yourself as an entity to if the information that you've obtained and the measures you've undertaken to mitigate the risk, to put your mind at rest that everything is above board, you haven't managed to do so, then you need to assess whether there is cause for suspicion. So for instance, trading activity with very high risk jurisdictions, and then this would be compounded by activities or sectors that are in and of themselves high risks. And we give examples of these in our implementing procedures, which are on our website. For instance, the payment method that your customer is using is exposing them to a higher degree of risk, and this doesn't make that much sense when there are other more secure methods of payment or channels instead. Then you should also look out for other unusual characteristics. So for instance, within the chain of transactions that you are assessing, there is the use of companies that appear to be nothing more than a shell company. So with transactions moving in and then swiftly out in a process of layering and distancing. And you should also ask yourself why there is this unnecessary complexity in the transaction and in the means of payment. Likewise, the use of unnecessary or unusual shipping routes. So if this is an area that you are familiar with and this is not the type of shipping route that is usually carried out to transfer goods from one country into another, then you would need to understand why. A classic red flag that is applicable with respect to all types of typologies is the use of complex or unusual payment instructions or unusual behavior from your customer with no logical justification. And then if, as Carmen mentioned earlier, if you note the exact same invoice being used more than once, or documentation perhaps that seems to have been forged or tampered with, of course then you have signs of fraud, evidence of fraud, and that should definitely lead you to submitting an SDR if you suspect that this is taking place. This is an interesting one if you know the payment for goods by parties that don't appear to be related in any way to the transaction. And this is likewise something that we know that you could note across different sectors and not just in the trade area. So who is this person that is not the buyer, neither the seller, and why are funds coming in from a third party? Is it bank funding? Is it a traditional financing instrument, or is there an unknown third party that is transferring funds without particular logical justification? And then you would need to understand who that third party is, the relation to the buyer, and the source of those funds that are coming in. And our final red flag, there are many red flags, but here we're selecting some of the more interesting ones, is that if the goods, as stated on the invoice, are being exported from a jurisdiction that does not produce or manufacture such goods, and likewise vice versa, if the goods are headed to a destination that is considered an unlikely destination. So to give you a very basic example, for example, machinery that is used to manufacture cars and vehicles is headed to Malta, being imported to Malta as a final destination, and there are no car manufacturing plants in Malta, for instance. So this would be something then that you have to use your knowledge and your experience to understand why this is taking place. Now, once again, we reiterate that a red flag is not an automatic indicator of money laundering, as Roxanne explained, but should serve as a trigger to question further. So for all these things that I mentioned now, and that even Roxanne mentioned with the case study, there could always be a justification, there could always be a legitimate reason. But this is something that should alert you, should alert your systems, should alert your compliance staff, and then you would need to act on it and understand the reason for this behavior. And then assess the situation against the customer's profile and what you know and what you've come to learn about your customer, but also about customer peers, so customers operating within similar sectors. And finally, we emphasize, of course, the importance of training of all employees, so ongoing and continuous and updated training of all employees that are involved in customer onboarding, in reviewing customer files, in reviewing transactions, or in any area that in some way or another touches upon anti-money laundering obligations. And this so that they are in a position to detect and flag suspicious transactions, which in turn, this can only be done, of course, if there are effective ongoing monitoring systems. So this was our presentation, our introduction on trade-based money laundering for today. I would like to thank Carmen and Roxanne for delivering Hello, sorry, it seems that we got disconnected. I just want to check that we're back on. Going to share our presentation. Sorry about that. So we were explaining some characteristics that indicate that an invoice could be forged. We don't have the specific information that this particular bank noted. However, what we can explain based on what we know, and perhaps we can supplement this with more information from our analysts, and this could be the subject of an interesting webinar, is to look at the details. So it typically takes an analytical eye to notice that something is wrong with an invoice. So for instance, a date would be off, and this would be the result of careless work by somebody who is not typically in accounting or in financing. You would have incorrect company names cited, believe it or not. You would have incorrect addresses or addresses that do not actually match the name of the company that the invoice is being sent to or is being received from. You could have incorrect registration numbers, so a false registration number attached to the company. And there could be other indicators. So for instance, something would not be normal practice in a particular country. Let's see if there are any other questions. There's an interesting question from Ben, and I'm going to read it out. So if a payment is of a large value, however, it's in line with the customer profile in terms of value and goods, provided that you find information on the beneficiary of the payment, do you still expect the banks to obtain supporting documentation before processing the payment? So this is a good question, and in it we can explain a bit about the risk-based approach, which requires you to have an understanding of the risks posed by the relationship. So if after you've carried out your business and your customer risk assessment, you haven't determined that the relationship is one of a particularly high risk, then as part of your ongoing monitoring, perhaps you don't necessarily need to obtain information for each and every transaction. And this is not something that we advocate. You do not need to obtain justifying information for each and every transaction, but rather for transactions that are different to what you expect from your customer and transactions that are not in line with your customer's profile. Of course, this presumes that you have built a sufficient customer profile when you are onboarding your customer, but also through the process of ongoing monitoring and keeping your information about the customer up to date. However, as I do say this, do bear in mind that there is a requirement to assess all unusually large transactions. So unusually large transactions could be a bit subjective, but if you are generally dealing with very large transactions from your clients, then this is something that you need to bear in mind in your customer risk assessment and understand whether you are mitigating the risks appropriately throughout the duration of the relationship. And this could very well mean that sometimes you would have to ask for substantiating information. And there's another question here from Catalin. Hi, Catalin. So Catalin asks, sometimes importers ask exporters to under-invoice in order to pay less taxes in customs. These funds used to pay for the invoices might be clean, but should this be seen as a suspicion of money laundering? Just remember that tax evasion is a crime and tax evasion is a predicate offense for money laundering. So rightly so, if you do suspect that there is an element of tax evasion, then this would need to be reported. In fact, one of the most common typologies for Malta is tax evasion. So a large chunk of suspicious transaction reports deal with tax evasion. So yes, please do report that transaction, and we'll give you an example from real estate. So we bring it closer to home and not importation and international exportation. If you are selling property and the buyer asks you to declare a lower value of the property just so that they could pay less stamp duty, likewise they are trying to avoid their fiscal obligations, and this is a predicate offense for money laundering purposes. So if there are no more questions, I say that we're almost running out of time. I'd like to thank you all for being here with us today. If you do have any other questions, please send an email on queries@fiaumalta.org, and we'd be happy to answer you in writing. Thank you very much. The recording will be available on the website. And from here, I thank my colleagues Carmen and Roxanne for being with us.
Thank you.
Thank you and have a good day.
Thanks.